Quick disclaimer. Before we start, a quick disclaimer. This video is for educational purposes only and should not be considered financial advice. Always do your own research and consider speaking with a qualified financial professional before making investment decisions. How to build a simple ETF portfolio in Canada, step-by-step guide. If you're new to investing in Canada, you've probably asked yourself this question. Should I buy individual stocks? Which companies should I pick? How many investments do I need? The truth is, many beginner investors feel overwhelmed before they even start. But what if you could build a simple portfolio with just a few ETFs that gives you exposure to thousands of companies around the world? In this video, I'll show you how beginners in Canada can build a simple ETF portfolio step by step. Section 1. What is an ETF portfolio? Let's start with the basics. An ETF portfolio simply means a group of exchange-traded funds that you own together as your investments. An ETF is a fund that trades on the stock market just like a stock. But instead of owning one company, an ETF usually holds dozens, hundreds, or even thousands of companies. For example, one ETF might track the entire Canadian stock market. Another ETF might track the US stock market. Another could track international companies. When you combine several ETFs together, you create a portfolio. This is how many long-term investors build their investments today, because it is simple, diversified, and low cost. Section 2. Why diversification matters. One of the most important concepts in investing is diversification. Diversification simply means spreading your investments across many different companies and markets. Why is that important? Because if you invest in just one or two stocks, your results depend heavily on those companies. If something goes wrong, your portfolio can drop significantly. But when you own hundreds or thousands of companies, the risk is spread out. Some companies will do well, some will perform poorly. Over time, diversification helps reduce the impact of individual company risk. This is one of the main reasons why ETFs are popular with beginner investors. A single ETF can instantly give you exposure to large parts of the global economy. Section 3. Why many beginners use ETFs instead of picking stocks. Many new investors start by thinking they need to pick the perfect stock. But stock picking can be difficult. Even professional investors sometimes struggle to consistently choose winning companies. ETFs solve this problem. Instead of trying to pick individual winners, you invest in entire markets. This approach focuses on long-term market growth rather than short-term speculation. Another advantage is simplicity. With ETFs, you don't need to follow dozens of earnings reports or company news updates. Your portfolio simply tracks the broader market. For many beginners, this makes investing less stressful and easier to maintain over time. Section 4. A simple ETF portfolio structure. Now let's look at a simple example of how an ETF portfolio could be structured. Many beginner portfolios include three main components. 1. A broad market ETF. This ETF gives exposure to a large stock market. For Canadian investors, this could include ETFs that track the Canadian stock market, the US stock market, or even the global stock market. A broad market ETF often holds hundreds of companies. This becomes the core of the portfolio. 2. An international ETF. Some investors also include an international ETF. This adds exposure to companies outside of Canada and the United States. For example, businesses in Europe, Asia, emerging markets. This further increases diversification. It allows your portfolio to benefit from growth happening around the world. 3. An optional dividend ETF. Some investors also add a dividend ETF. Dividend ETFs focus on companies that regularly pay income to shareholders. This can provide cash distributions, often paid monthly or quarterly. However, it's important for beginners to remember something. High dividend yield does not always mean better returns. Many long-term investors focus first on diversification and growth. Income can be a secondary objective. Section 5. Understanding long-term investing. One key idea behind ETF investing is long-term investing. Markets move up and down in the short term. Some years will be strong, other years may be negative. But historically, global stock markets have tended to grow over long periods of time. This is why many ETF investors focus on holding their investments for years or even decades, instead of reacting to every market movement. Consistency often matters more than timing. Regular investing over long periods can help investors gradually build wealth. Section 6. Understanding risk tolerance. Another important concept is risk tolerance. Risk tolerance simply means how comfortable you are with market fluctuations. Some portfolios focus heavily on stocks, which can grow faster but also fluctuate more. Other portfolios include bonds or lower risk assets. Beginner investors often choose a portfolio that matches their time horizon and comfort level. If you're investing for the long term, you may be more comfortable with temporary market volatility. But everyone's situation is different. Section 7. The importance of consistency. One of the most powerful investing habits is consistency. Instead of trying to predict market movements, many investors simply invest regularly. For example, monthly contributions, automatic investing, long-term reinvesting. This strategy helps remove emotion from investing. Over time, consistency can help investors stay disciplined and focused on long-term goals. Section 8. Common beginner mistakes to avoid. Before we finish, let's look at a few common mistakes new investors make. Overcomplicating the portfolio. Some beginners believe they need 10 or 20 different investments, but in many cases, just a few well-diversified ETFs can already provide exposure to thousands of companies. Simple portfolios are often easier to manage. Chasing high yields. High dividend yields can look attractive, but extremely high yields may come with higher risk. It's important to understand what you are investing in rather than focusing only on income. Trying to time the market. Another common mistake is trying to predict market highs and lows. Even professional investors struggle with this. Many long-term investors instead focus on staying invested and contributing regularly. Final thoughts. Building a simple ETF portfolio in Canada doesn't have to be complicated. Many beginners start with just a few ETFs that provide exposure to the broader market, international companies, and sometimes dividend-paying stocks. The key ideas are diversification, long-term thinking, and consistency. Over time, these principles can help investors build a structured approach to investing.
Call to action.
If you're starting your investing journey in Canada, I'm building a simple step-by-step guide on this channel. Consider subscribing so you don't miss the next part.